What's going on, guys? In today's video we're going to be adding two new companies into my trading 212 portfolio. One will be in the tech sector and the other is going to be in the consumer discretionary sector. The reason I'll be adding in a company into each of these sectors is because over the weekend I've had a look through each of my sectors, and as you know, I want to have 5 companies in each of my 12 portfolio pies to help improve my diversification. We've seen that I have 5 already in the financials, materials, real estate and utilities, and I'm also fully diversified in my ETF portfolio, and also here in my energy sector portfolio. I'm quite happy with how diversified I am there. However, as you can see here in the tech and the consumer discretionary, we currently only have 4 companies in each. So in today's video, I want to add in one further company into each of these portfolio pies to have 5 companies overall and to help improve my diversification. You can see here that my overall portfolio is currently worth about €4,927. We're up about 6.75%. But we can see here then, if we go into my consumer discretionary, that we currently have 4 holdings, and our overall value of my consumer discretionary pie as of now is about €363, or about $400 overall, and we're up 5.41%. Currently, we have 4 holdings, as I said, in the form of Tesla. We're up 26.79%, which I'm quite happy with. McDonald's, we are down just under 2%. Starbucks, we're up 0.63%. And Nike, we're pretty much at break even, up 0.08%. In terms of the consumer discretionary sector, there is currently about 63 companies on the S&P 500 in this sector, and the company that we're adding, and the fifth and final company that is Target Group, and that is also one of the dividend aristocrats, and that will be the company we're adding today. We can see here on Market Watch that Target engages in owning and operating of general merchandise stores. It offers curated general merchandising and food assortments including perishables, dry grocery, dairy and frozen items at discount prices. It was founded by George Draper Dayton in 1902 and is headquartered in Minneapolis. Target is traded on the New York Stock Exchange and has ticker symbol TGT, and at time of recording their share price was about $172. As I said earlier in the video, Target is on the dividend aristocrat list, and it currently pays a forward dividend yield of about 1.58%, or $2.72 per share. We can see on the company's 1-year chart that they've done quite impressive since this time last year, all things considering, especially with the dip in March. So this time last year they were sitting at about $127 or so, had a bit of a nosedive like the majority of companies in March due to the pandemic, and dropped down to about $92.50. But since then you can see they've had quite a fantastic run of form, and they're currently now at about $172.30 a share, which is quite impressive. Obviously, Target is in the consumer discretionary sector, and its industry being discount stores. They currently employ over 368,000 full-time employees. We can see here by their financials in terms of total revenue, and obviously the bottom line being gross profit. It has went up year on year over the last 3 years, between 2018, 2019 and now 2020, as we're heading into the new year. And if we go to their top holders, we can see down here that Vanguard Group make up 8.68% of their overall shareholders. We then have State Street with just under 8% and BlackRock with 6.93%. It's certainly been a good few weeks for Target, as we can see that their stock has risen after beating expectations. And if we scroll down a bit here, we can see that Target is up 0.5%, reported after Wednesday's third quarter net income of $1.01 billion, or $2.01 per share, up from $714 million or $1.39 per share last year. This adjusted earnings per share more than doubled to $2.79, blowing past fact sheet consensus for $1.60 and reaching a record. So we now have Target added to my consumer discretionary pie. So now we have Tesla, McDonald's, Starbucks, Nike and Target being our new position. We can see on the left here that we have an average annual return of 17.27% based on 5 years historical market performance. And the second company that we're adding today will be in my tech sector. We currently have 4 holdings, and this is currently my largest holding position pie. We have €1,077 invested, and are currently up about 7.67%. The 4 holdings we have as of now are Microsoft, which is up 2.23%, Amazon, which is up 1.5%, Apple, which is up 6.8%, and Alphabet Class A, which is up an impressive 20%. In terms of the S&P 500, there is currently 73 tech companies on that ETF, and the company that we're adding is on this ETF, and it is IBM. So just a quick synopsis of IBM, or International Business Machines. It's an IT company which provides integrated solutions that leverage IT and knowledge of business processes. It operates in cloud computing and cognitive software, cloud business services, cloud tech service systems, and global financing. IBM is traded on the New York Stock Exchange and has ticker symbol IBM. At time of recording, its share price was just under $117 per share. We can see that their forward dividend yield is an impressive 5.58%, or $6.50 per share, which is paid on a quarterly basis. Now, in terms of the 1 year chart, this time last year they were at $134, and obviously had a nosedive down to about $95 in March. And the company, in all honesty, has been doing quite well overall, and even on the 5 year chart, it is in the red. But again, if you're buying in at, let's say, $116, I still find this company to be undervalued. Again, even though that they were up about $175 a share. But when you're buying in at these prices, you kind of have to realize this is your starting point and it actually wasn't up here. So let's say if you bought around here, then maybe it was a bad price. But because it's gone down to about $117 a share, I do think in the long term, IBM is definitely a successful business. And I think it's a good long-term investment, as I believe it's undervalued right now. Even though their stock price hasn't been quite well over the last few years, it's still quite impressive that their gross profit has been consistent over the last 3 or 4 years, and to be honest, it's nearly the exact same gross profit, which is still quite good to see. At least it's not going in a backward trajectory, which the stock price is. So it's good to see that the gross profit is still kind of around the same ballpark figure. And again, that's the best thing about long-term investing, is that even if I bought at, let's say, $170 a share, if it goes down to 110 or even 100, or could even be less, then you can buy a lot more of the shares, and which helps improve your dollar cost averaging. And as a long-term investor, that's certainly key. We can see here on their profile that they're in the tech sector and their industry is IT services, and are currently employing over 352,000 full-time employees. IBM's top 3 shareholders are the Vanguard Group with 8.32%, BlackRock with 6.84%, and State Street with just under 6% holding. One of the main reasons why I like IBM is because they're getting involved in cloud-related companies, and we can see here that IBM announced the second cloud-related acquisition this week. The shopping spree IBM continues as the second acquisition of the week. The company announced an agreement to buy Astana. This closely follows IBM's announcement on Monday that it would buy finance and analytics company TrueQ Enterprises. Now that we have added IBM to my technology pie, we now have 5 positions in Microsoft, Amazon, Apple, Alphabet Class A, and again, new position IBM Corporation. This gives an average annual return based on 5 years historical market performance of just under 23.5%. Again, I'd take that any time of the year, considering that ETFs, kind of the S&P 500, has an average gain of about 10% per year. So this would nearly be 2.5 times beating the ETF sector pie. So with all that being said, that's 2 new companies that I've added into my overall portfolio. One in consumer discretionary in the form, if we go in here, so in the consumer discretionary in the form of Target, and also one in my technology sector in the form of IBM. So now that only leaves us with 4 different sectors that have less than my required quota of 5 companies, and that's the industrials, which has 3, healthcare, communication services, and consumer staples all have 3. So in tomorrow's video, we will look at consumer staples, which currently has Coca-Cola, Pepsi, and P&G, and we're looking to add 2 further companies into this sector. So thanks very much, guys. If you liked this video or found it anywhere helpful, please consider subscribing to the channel. Or even if you're new around here, again, it'd be great if you could like the videos, as we really have the channel out going forward. And it'd be brilliant as well if you comment below on your thoughts or views on my overall portfolio, and in particular my consumer discretionary and technology sector pies, and if you hold any of these companies, and also if you think I should have added any other companies that you may have in your own portfolio. So thanks very much, guys. I'll see you on tomorrow's video for adding 2 more companies into my consumer staples pie.